Hello and welcome to today's presentation regarding the state of the market in 2023. I am your host and your guide, Greg DuPont. And just a quick moment here, we're going to get started. I do want to make sure that if you haven't done already, grab yourself a piece of paper and a pen so that you can take some notes as we go through here, because there's a lot of stuff here that you're going to want to be thinking about, reflecting on after we're done with the presentation today. Presentation is going to be about 25, 30 minutes here. Don't want to take too much of your time, allow you to go on to the evening. But there's a lot of stuff to be talked about, a lot of things to contemplate, considerations to make as you are thinking about what to do for yourself and your family in 2023. Brief moment about who I am in case you're not aware. Again, my name is Greg DuPont. I am an attorney and financial advisor. I started practicing law back in 1992 as an estate planning, business, and tax lawyer. About 15 years ago, I also started the process of becoming fully licensed as a certified financial planner. And today I have multiple businesses that are built around the idea of helping people like yourself preserve, protect, and transfer their assets. I consider myself a capital preservation and retirement income specialist. The type of people that I work with are those people that are looking to try to preserve, protect, and grow their assets. They have done their fair share of risk taking and are now looking to enjoy the fruits of that labor. And so as we go into our conversation about what 2023 is going to bring us, we do have to take a moment and reflect back as to what 2022 taught us, because 2022 brought in with clarity that nobody has a crystal ball, let alone myself. And I'm going to reflect on a couple of items that drive that home. The first is the Fed, the repository of all financial knowledge, the people that are the grand poobahs that are making the decisions that are driving our economy. Well, as we came into 2022, you might remember that they used the phrase transitory about inflation. See, they were thinking that as 2022 was going to evolve, they were looking at GDP, or gross domestic product, growth of about 4%, on inflation of about 2.6%. Now, we all lived and realized how little they know about that, right? Instead, GDP growth was about 0.5%. Inflation, plus or minus, around 7%. And let's talk about the gurus of the stock market. See, I read many financial publications, so you don't have to. One of my favorite ones is Barron's, one of the better sources of information. And every year they put out their prediction. They have their roundtable predictions of the top, I'll call them stock jockeys. And see, I'm not a stock jockey. I look at putting together structures and putting things in the right places, not particularly buying winners and losers and picking what stocks are going to be the best ones. But this is instructive because the best minds that Barron's had to pull from last year, as they reflected upon their choices for 2022 and their faulty crystal ball, I want you to kind of grab a hold of these numbers here. So each of these people, there are a dozen people, and I'm not going to read them all, but each of these people picked 5 stocks for 2022 based upon all of their knowledge of the stock market. First one here, their first stock, well, that had a return last year for 14.4%. Hey, good job there. Next one, -7, -5, -34, -34, -9.9. That's one guy. One of the best minds on Wall Street. Another one. He had 4 picks, -16, 4.1, 89.1. I want that stock. 25.4 loss. Another one, -39, -10, et cetera, et cetera, et cetera. I can go through each one of these dozen experts, and the pattern is the same. 2022 was a year that the experts on Wall Street didn't see coming. Why? As we approach 2022, we are telling all of our clients, anybody that would listen, hey, the writing is on the wall, this thing is going to fall. But the market bias ran rampant. Last year, the S&P lost around 18%. The NASDAQ, the tech companies, lost 33%. Its worst year since 2008. And here is what got most people so off guard. The Vanguard total bond, or the measure of the total bond index, lost 13.7% in 2022. Now, folks, I have long contended that the way that bond funds are sold to you, the consumer, is the biggest fraud in the market this side of Bernie Madoff. You see, there are only two reasons to own a bond. That is, that you'll get your money back if you hold it to its maturity, and that you can get interest paid on it at a stated rate. With bond funds, as people experienced last year, you get neither of those. So 2022 was a year for the record books, but it wasn't unforeseeable. And we need to take the lessons of history and build off of them, because 2023 may be very much like 2022. I want to take a quick moment here to address the Secure Act 2.0 that was passed in the dead of night, the end of 2022, much like Secure Act 1.0 was passed in the dead of night, the end of the year, back when it was passed. Now, there are some headlines from the Secure Act 2.0 that you need to be aware of, and some could argue are good. I'm going to contend not so much. First, the changes to required minimum distribution. For those that are unaware, required minimum distribution is the backside of the deal with the devil. You see, the government realized that if we're going to have money saved and we did not have to pay tax on it and we didn't need it, we'd leave it there indefinitely. Well, the required minimum distribution is there to make sure that we pull it out and get taxed on it. Okay, so it's been moved from 72 years old to 73 with the passage of the Secure Act 2.0, and it goes up to 75 in 2033. Now, they're serious about this, folks, and that's why they've always had a penalty of 50% if you fail to take that required minimum distribution. Good news is they have reduced that penalty now with Secure Act 2.0 to only 25%. Hey, isn't that nice of them? But as you will hear throughout our conversation tonight, don't take this at face value. Look at the reason behind what they are doing. See, what many people that are uneducated on this issue, uninitiated into the thought of RMD and the ticking tax time bomb that is part of that whole structure, they're going to say, hey, great, I don't need to take it out, and I'm going to let it continue to grow. As we'll talk about, that could be a fatal mistake. A couple other things that are good about Secure Act 2.0. If you're between the age of 60 and 63, you're actually able to put even more money into tax deferral during those large earning years of yourself. There is a little bit of a Secure Act catch-all in the fact that they decided that maybe when people don't use all their money in 529s to pay for college, they should have ability to move it out without paying taxes on it. So now there's a limited availability to roll from a 529 to a Roth. Certain restrictions apply. Another thing that changed from Secure Act 2.0 going into this year that you should be aware of if you are in a RMD type of situation is that they've increased the QLAC limit, a qualified life annuity contract, which allows you to park some money aside and not pay RMD on it. They've increased that limit to $200,000. So that is something that is a very powerful tool for many people, thanks to Secure Act 2.0. And they also increased the amount that you can use for a qualified charitable distribution from your retirement accounts. And here's one that I found kind of good, because I've had this problem many times over the years both with clients and more particularly with estates that we worked with, a retirement savings lost and found. You would be amazed how many people lose track of their old 401ks. Well, so now they're creating this registry that is going to allow us the ability to try to track down some of these old retirement funds that are sitting out there in pools of money that nobody knows where the heck they are. All right. So as we are looking into 2023, I want to stress what the numbers are telling us. You see, one thing that experts have come to consensus on is that the sell-offs in the market last year really were driven by the interest rate changes and not in the anticipation of what the corporate earnings will be, not what they actually were. The earnings were fairly strong last year, but the Fed had a 1-2 punch. They started increasing the interest rates, and they started what was called quantitative tightening. You see, in COVID, they threw a lot of money in the system. And then they saw that the genie was out of the bottle. They had to find ways to start pulling the money out of the system. One way was through raising interest rates. The second way is this quantitative tightening. See, they were actually buying stuff in the stock markets, and now they started selling it. And this is part of the reason why folks like myself that are more capital preservation oriented, we're out here saying, hey, the party is over. Get yourself adjusted coming into 2022 because the Fed's going to have this double whammy pulling down stock prices, which is exactly what happened and exactly what may still happen in 2023. Because in addition to the continued effort by the Fed to reduce the inflation that the flooding of money has caused, there's now talk that we will be entering into recession, where the profits are going to start being impacted. So potentially, we have a snowball effect, where we have the Fed's continued tightening of money, and now the companies with the economy going into recession are starting to have their own economic difficulties. And ask yourself, as we look at 2023, against that backdrop of those difficulties, what are the driving forces for market growth? So I contend, as do many others, that as we look forward to 2023, there is a lot of downward pressure and very little momentum to have things going upwards. And let's talk about downward pressure a little bit. This is one of the charts that I use to guide myself through my conversations with my clients and making decisions. And this is looking at the market at a broad overview. You see, this Shiller PE ratio, which is a measure of earnings versus the value of the market, as it were, right now it's at 29.24. If we were having this conversation this time last year, it was at 41. The median over time is 15. What's all that mean? So the median is the average, we'll call it, of what the market is valued at over time. The highest it's ever been was 44.19 in December 1999, right before Y2K crash. We were at 41 last year. We've gone down 12 points since last year. And if we are going to the mean, what the market calls reverting to the mean, we could still have another 10, 12 points to go down. So that loss in the S&P that we stopped before, we might be halfway to where it's going to go down to. I don't have a crystal ball, folks. I just look at the numbers, try to figure out how do we structure things to protect against this. And if we look at the total market capitalization versus GDP as of January 13 at 154.9, Well, according to the experts like Warren Buffett, everything above 135 is still significantly overvalued. So these numbers are telling people like myself that the market is still overvalued, could still have a good amount to go down. And as a fan of Warren Buffett, he's got two rules of investing, two fundamental rules of investing. First rule of investing is don't lose money. Second rule of investing is never forget the first rule of investing. So as we look into 2023, we need to recognize where we are in our life. If we're in a spot where we got a long run ahead of us, we're early on in our savings journey, then there might be some opportunity. We'll talk about that. If we're not, if we're near that spot where we are going to need our money, because things fundamentally change when you move from the savings journey to the use of our savings journey. If you're in that spot where you're either in that use of savings journey or nearing that, then it's like the client I spoke with the other day. Said, Greg, I just don't have, time is not on my side anymore. I can't afford to live through this way. We got to figure out, how do I have predictable, reliable income? And if that's the type of position that you're in your life, then at the end we'll give you a little opportunity to chat with a member of my team. Perhaps there's something that we can do to help you out of this. But we need to proceed with caution where we are right now, because history is telling us what may happen. Again, no crystal ball, but let's look at the three paths forward for 2023. First path is the Fed has it right. They figured it out, and they're going to go for that soft landing, which means that they're able to get through this increase of interest rates and bring down inflation without having us tip too deeply into recession. Now, I shared with you their predictions going into 2022, so that does leave us with a little bit less confidence. And if we understand what the Fed is looking for 2023 with their soft landing, they're looking for about 0.5% real GDP growth. Now, folks, over the last 15 years, we've had about 2% a year as our GDP growth. Okay, so again, even if we have that soft landing in 2023, don't look for this miraculous rebound of value. It's not going to happen. The only time that's happened has been when the Fed has pumped more juice into the juice bowl. Okay, that's not happening. We have to grow out of this organically. It will happen over time, but again, if you're like that client, time is not on your side. If you've got a long time perspective, then some great opportunity potentially. So that's one path. The Fed has it right. They're going to bring us in for that soft landing. Well, the other path that could happen is they overstep their bounds, that they pull out too much, or they can't get control of the inflation and have to keep ratcheting up the interest rates to the point of pain. Now, many of you may remember vaguely the Carter-era stagflation, high interest rates, low productivity. Many experts say that's where we are headed. And to get some perspective on that, you see what happened back then is the Fed had to pull money out of the system. That's why all the interest rates went up, and that's what they're trying to do now. But one of the things that people don't understand, when we saw the Fed dealing with COVID, the money printing that was done is extraordinary. In the year 2000, when America's population was 300 million, the money supply, as we refer to as M2, was $4.9 trillion. In 2022, with a population of 330 million, which is a 10% increase over 2000, The M2 money supply was $21.4 trillion. That's a 435% increase in the money supply. Is it any wonder that we're swimming in this money that's causing this inflation? And can the Fed pull this sleight of hand, getting this all out of the system? Forget the COVID lockdowns and all that kind of stuff. Every prior dose episode of inflation that we have had after World War II was done in a fundamentally different Fed system, where we had scarce money, not this flood of money out there. So will Fed ever shoot? I don't know. No crystal ball here. The third path for 2023 is that maybe we're on track, and then there's some triggering event that blows things up. And because the Fed is fighting with this liquidity issue, they don't have some of the tools that they had before, like when COVID hit, when they started throwing money in the system. And so some of these trends that we are dealing with in 2023 and into the future could have that triggering event type of capacity. This deglobalization that we've been dealing with and trying to get the supply chains moved back on shore. The political acrimony that we've been dealing with, the DC is dysfunctional, right? We can agree on that, right? The demographic change that we are going through with the silent quitting by people in the workforce to the mass resignation or mass retirement of the people that are older in the workforce, and the lack of influx of migrant work. We are losing the workforce. The shift in our energy sources. I'm not going to make a political comment about global warming or anything like that, but it is real that we are shifting where our energy comes from, be it right, be it wrong. And that has costs associated with it. And as we saw last year in the context of Russia and the Ukraine, well, there are disruptions that are going on in that energy system. And a note here about a trend that is troubling, and that is a shift to private equity. Now, private equity is a good tool, okay? However, what people need to understand is that there has been a sea change in where companies are getting their lending. It is now coming predominantly from private equity, not from banks. And the Fed is trying to affect corporate policy through the supply of money through banks, while the companies are going outside of the banks to get money. This is a different world than the Fed has worked with before. And this shift to private equity has a lot of junk bonds involved in it. And to some commentators, it feels a lot like 2008 and what happened with the mortgage crisis. It feels a lot like some of the other events in the past, the failure of long-term capital management. I'm sure no one knows of that, but some of these other failures that triggered other big drops in the market, there's some concern that this reliance now on private equity sets us up similarly. So this is what we are being shown by history. These things do repeat themselves. And what you need to understand is that you can protect yourself and your family from these shocks. But you've got to get past the paradigm of just the market. You've got to start thinking about all of the tools that are out there to help you and your family get to where you need to be. And very precisely, you need to start thinking about how do we protect ourselves and our families from the impact of tax change, which is right around the corner. right? So what's the government indicating? Well, again, the Fed, their target, they're saying the growth rate is going to be 0.5%, and they're going to get the inflation down 3.1. Take it for what that's worth. The market, through various purchases that they make, we know that they are expecting another 0.75% rate increase. And we know from what we've seen that gridlock still reigns in the government. But I want to highlight two things in that. Again, not being political about this, just making you aware of the risks that we are facing. First is the continued fight over college loan forgiveness. There are trillions of dollars at risk in that, which is either another inflationary event when things get forgiven, or a tremendous problem and drag on the youth of our country that have these loans. I get it. I've 30-year plan to pay off my college loans, my student loans for law school. This is a fight that is being administered, not being solved politically. And I just read this the other day, because it's just now happening, that the Biden administration is making a push to take a great level of control over the rental industry. Now, my constitutional law training gives me all kinds of reasons why that wouldn't be fly. It would not be something that the Commerce Clause allows. However, what's happened is, with all of these financial programs, so much money that buyers of rental property have used is coming from federal sources. So quite possibly, there is enough basis there where the federal government could control lease rates here in your backyard across the country. And that's what they're arguing about right now in the administration, not in Congress. Biden's trying to, or people are trying to get Biden to do this. I'm not sure what he wants to do, but that's what's happening right now. So that will be a huge fight if that happens. And then replenishing the strategic oil reserves. Folks, we're dealing with inflation. We started to get off the mat with regard to the cost of fuel, and now the government is starting to replenish the strategic oil reserves that they drained to try to get the prices under control. So we have demand issues. So we got more inflationary pressure that way. This is what the government is telling us right now. So what are the experts saying to expect for 2023? So there's been what's called an inverted yield curve. And that's essentially where we've got this disparity between long-term interest rates and short-term interest rates, and it makes it better for people to do one thing or the other. Long story made short, many experts say that is a sure indication that recession is imminent. And the tech stocks have been crushed, and maybe for good reason. The Russell 2000, about 40% of the companies in the Russell 2000 growth lost money, showed a loss. It reminds many of us of the early days of the internet bubble. And so there's a big adjustment there. And anytime you see the ad on TV for the QQQs, used to be a great fund, but it's kind of the poster child right now for the tech stocks and the problems that they're having. But the experts are also saying that tactical opportunities exist, that there are pockets there. The stock advocates are saying this is the time where stock pickers shine. Again, I refer back to the Barron's Roundtable from last year, where the best minds in the market were basically all throwing darts. And see, folks, that's one of the dirty little secrets over the last 20 odd years, is that with a bull market, anybody can have positive returns. Got to be really bad not doing it. So we are now at a different time. Again, it is a buying opportunity for long-term investors. Some of these 40% of the growth stocks that are losing money might be down the road big winners. So it all depends upon your timeline. You know, folks, I'm a very positive guy about what's going to happen down the horizon. I'm not very positive about what's going to happen in the next 12 to 18 months. So what are some strategic actions for you and your family to take? First, we have to be thinking about whether you've got a short-term or long-term picture that you are personally dealing with. You know, if you are in that long-term growth mindset, then you can look for opportunities here. If you are in the short term where you are at that spot where you're going to need income from your savings now or in the near future, you need to take some protective action. For God's sake, folks, right now you can go and go to CapitalOne.com and get 3% on a money market account. Why lose money in the market for the next year when you can do something like that? Market risk, focus on quality and not speculation. Too many people are still playing games with trying to catch the hot stock. It's not where we are. What you also need to understand is inflation. There's been a two-headed impact to that. One is that we have been squeezed. The other is, hey, now we can put more into our 401k because of the indexing of that with inflation. So it's now $22,500. A couple of other things that people need to be aware of if you are in that spot in your life. The child tax credit that many people got during the pandemic has now been reduced to pre-pandemic levels. So there might be a little bit of a surprise in your 2022 tax returns. So with this uncertainty, what's going on in the market, I contend that right now there is a need to renew your focus on your personal debt and budget. So I know I've seen it too many times. People are saving money in losing funds when they're bleeding out with interest. We need to take control of ourselves and our future. You see, here's the secret. Governments at all levels are getting boxed in and are running out of time. And we're reasonably intelligent people here, right? Do we really feel that all this spending can continue indefinitely? And if you think about it, aren't they limited in how they can fix this problem? First, they can raise taxes and fees of all kinds. Second, they can lower the promised benefits. Third, and this is the promise that they try to make, that we'll grow our way out of these challenges. And let's get real here for a minute. Aren't we averaging 2% growth over the last 15 years with the recession on the way? And if you put inflation into the factor, haven't we actually had 15 years of negative growth in the GDP? And with inflation being higher in the future, with these headwinds, when will we really see real growth again? Fourth, they can print enormous amounts of money like they've done in the past. The year 2000, again, when the population was 300 million, $4.9 trillion of money. 2022, population of 330 million, $21.4 trillion. So we know what they're going to do, right? They're going to use a combination of all these things. And right now, we have 3 more years where taxes are on sale. Until the Tax Cut and Job Act expires, we have 3 more years to make some moves that can seriously change the dynamics in your favor going forward. So as we wrap up here today, a couple of things for you. If you have not yet had our retirement roadmap experience, I would invite you to reach out. I'm going to put up a thing here for you to click in and take advantage of this opportunity to have our retirement roadmap experience, where you'll see what life looks like for you down the road, the impact of taxes. Are you going to have enough money? Do you have the capacity to live the life that you want to live? If you are carrying any kind of debt, be it just a mortgage, there are ways that we can remove that debt more efficiently, many times simply by repositioning the way that you're paying your bills. Take advantage of the opportunity to talk to one of my specialists about our debt elimination programs. If you feel like maybe you've got too much risk, or you're looking for ways that your portfolio could be repositioned to take advantage of opportunities for 2023 because you are on a long-term view, or because you want to protect what you've got, you want to have a complimentary portfolio review, again, you'll have a link that you can click to take us up on that offer. And if you're in the spot where you wish to preserve your estate and give it to those that you want to take it, not the government through excess taxation, take us up on the opportunity to chat with us, and we can talk about an estate preservation plan. So I'm going to throw up here a link that you can jump off to schedule time to chat with one of my associates to see if there's anything that we can do to help you with anything that might have come across your mind here today. So with that, I wish you a good day. Take care. Be well.